So we are right in the middle of Q4 result season. And honestly, it's been a mixed bag so far. On one side, many nifty heavyweights have disappointed the market. For instance, large private banks like HDFC, ICICI have seen muted reaction despite decent operational performance. IT giants like TCS, Infosys, HCL have also struggled because growth expectation remained weak. Even Reliance has underperformed for a long time now. But at the same time, there are quite a few companies that have posted genuinely strong Q4 numbers. And more importantly, the market is rewarding that performance immediately. We are seeing sharp earning-led moves where stocks are breaking out purely because execution, margin, order book, or growth visibility have surprised positively. And this is where many retail investors make a classic mistake. The moment a stock hits a 52-week high, many people assume that stock has jumped too much and the rally is over. On the other hand, they become more interested in stocks making 52-week low because that appear cheap. But market don't work that way. A stock can double and then still double again provided the earning growth remains strong and valuations are still reasonable. In fact, some of the biggest wealth creators in the market have spent years continuously making new highs because the underlying business kept compounding. Meanwhile, a stock at 52-week low can always fall even further if earnings are deteriorating, balance sheet stress is increasing, or growth visibility is weak. In fact, when a fundamentally strong company is available near 52-week high with improving quarterly numbers and strong future guidance, that itself can sometimes be a signal worth studying more deeply rather than ignoring it. So in this video, we'll look at 5 companies where not only were the Q4 results outstanding, but the market is also rewarding shareholders with strong outperformance in stock price. But at the same time, one important caution here. Strong Q4 results alone are not enough to blindly buy any stock. In the market, future expectations matter far more than past numbers. Sometimes a company delivers excellent results, but valuations already fully priced into that growth. And in some cases, the stock run up so sharply after result that risk reward becomes unfavorable in the short term. So while analyzing these companies, the key focus should not be just on how good the quarter was, but whether the business can sustain that growth in near future, whether margins are durable, and whether valuations still leave room for compounding ahead. In case you do not get enough time to track the market and individual stocks, you can explore my weekly video series where I share one exclusive video every week that include key government initiatives and impact on various sectors, recent development in the market, key trends, along with tracking quarter results of nearly 200 companies. I also maintain an Excel tracker where I document everything. It really helps in identifying the next big opportunity. Plus, I also share my own investment strategy and thesis behind stock buying and selling. But this series is helpful only for long-term fundamental investors and for those who genuinely want to learn, not for those who are looking only for stock tips. For more details, you can explore my website or join button on this YouTube channel. Alright, let's get started with today's video. So first company in the list is Acutaas Chemical. Company's revenue is up 40% year on year and net profits have jumped by 111%. So Acutaas has two business verticals, pharma intermediates and specialty chemical. Pharma intermediate account for 88% of company's FY26 revenue, and in Q4, pharma segment has grown 43.9%. Specialty chemical is up only 12.9%. But since pharma intermediate account for 88% of company's FY26 revenue, company's overall revenue growth is 40%. Just look at the margin expansion from 27.5 to 42.4% in Q4. Hence, the profit has jumped more than 100%. The most interesting part is management continue to remain bullish and guided for 25% top-line growth in FY27. Although they did mention near-term cost pressure due to global supply chain disruption, but they are confident of maintaining the EBITDA in FY27 at similar level of FY26. Please note that Q1 is their weakest quarter with revenue steadily increasing sequentially till Q4, which is always the strongest quarter. So first half contribute 40% and second half 60%. The interesting part of Acutaas Chemical is, so far the growth has come from pharma intermediate segment that would continue to do well. At the same time, company is aggressively scaling its battery chemical and semiconductor chemical business. They have invested 195 crore in capex in FY26 for battery chemical plant. Then Equitas has invested 190 crore in joint venture with South Korea based company Indicam, which is in business of manufacturing specialty chemical for semiconductor industry. So overall, company has 3 growth engine, out of which only one has fired so far. and the other two looks equally promising. Equitas has been a big wealth creator for the investors, and stock price continue to rise. In fact, even FIs have increased stake in the company. Now, if you are following this channel, we have discussed this company multiple times in the past. Earlier, it was known as Army Organics. As far as valuation is concerned, at PE of more than 60, it is certainly not cheap. But considering FY27 guidance and growth potential, Equitas will command a premium valuation. So if growth revenue can be 25% and net profit grows at, let's say, 30%, at P ratio of 60, the PEG ratio would be around 2, which is neither too high nor too low. Ideally, I like to invest in companies where PEG ratio is 2 or below that. Then second company that has posted outstanding number is Navin Fluorine. Company's revenue has jumped 34% and net profits are up 124% year on year. Now Navin Fluorine has got three business verticals. First is high performance product. This business includes your refrigerant gases, inorganic fluoride and several advanced fluorinated chemicals used across industries like refrigeration, air conditioning, electronics, industrial manufacturing and specialty material. This segment has historically been the core earning driver for the company. Second is specialty chemical. Under this business, company manufacture fluorinated intermediate and specialty molecule which are used in agrochemical, pharmaceutical and crop protection product. Then third is CDMO. Under this business, Navin Fluorine partners with global innovator companies for custom synthesis, process development and contract manufacturing of fluorinated molecule. Now, this is the fastest growing vertical in company's entire business. The reason is because CDMO is a high entry barrier business because customers usually require deep chemistry expertise, regulatory compliance and long-term reliability before outsourcing manufacturing. Please note that this outstanding earning growth is due to massive earning expansion in FY26. Going forward, management has guided to maintain 30% plus minus 2% margin for FY27. So scope for margin expansion is not much in FY27. That said, the potential is solid. Company's stock price continued to perform well even after the result. As far as valuation is concerned, PE is certainly not cheap, but Navin Fluorine has always commanded a premium valuation. And considering the growth potential, it will continue to command a premium. But company need to maintain 25% kind of earning growth trajectory to justify these valuation. Third company in the list has a turnaround performance in Q4. It's Equitas Small Finance Bank. While its Q4 revenue growth is around 12%, its net profits have jumped 400% from 42 crore to 213 crore. Now, Equitas has gone through a fairly difficult phase over the last 2-3 years. One of the major pain points was stress in microfinance segment. Across the industry, unsecured lending saw rising delinquencies after COVID and later due to over-leveraging in lower income borrowing segment. Since Equitas historically had meaningful exposure to MFI, asset quality started deteriorating and credit cost increased sharply. At the same time, the bank was consciously shifting towards secured and granular retail lending segment like housing finance, small business loan, vehicle finance, gold loan. This transition was strategically important, but in the short term, it created pressure because secured business usually scales slowly compared to unsecured MFI lending. Now, Q4 FY26 appeared to be a major turnaround quarter because multiple stress indicators improved simultaneously. The first important trend is sharp improvement in cost of fund. It has fallen from 7.54% in Q4 FY25 to 6.94% in Q4 FY26. For bank, this is extremely important because deposits are essentially the raw material. When funding costs fall, profitability improves directly. Next KPI is net interest margin. This has collapsed from 7.1% in Q4 last year to just 6.29% in Q2 FY26. But now, NIM has sharply recovered back to 7.29%, which is one of the strongest levels in recent years. The third important indicator is credit cost. In Q1 FY26, total credit cost has exploded to 6.48%, mainly because of additional provisioning and stress recognition in MFI portfolio. But now, credit cost has fallen sharply to just 1.1% in Q4. Asset quality trend also show clear stabilization. Gross NPAs improved from 2.89 to 2.49%, while net NPAs fallen from 0.98 to 0.68. Provision coverage ratio has also strengthened sharply. Now look at the profitability metric. This is where the turnaround becomes very visible. ROA has collapsed to negative 1.68 in Q1 of FY26, but quarter after quarter, profitability improved and ROA has now recovered to 1.46%. Similarly, ROE has moved from deeply negative territory of minus 15% in Q1 FY26 to 14.1% in Q4. Now that is a massive swing within a few quarters. It shows the bank has moved from capital destruction back towards generating healthy shareholder return. So overall, it's a turnaround quarter after a long time. Also, management has given a good growth guidance for FY27 with exit ROA of 1.5% and overall ROA of 1.2%. So there's a sharp recovery in share price from the lows. And the good part is, valuation remained quite attractive at price to book trading below its historical median. So there is good scope for valuation re-rating. DIs have been a massive buyer in Equitas since last many quarter and public holding has also fallen sharply. Interestingly, ace investor Ashish Dhawan has consistently increased stake in Acutaas. Fourth company in the list is BSE. Company's revenue has jumped 85% year on year and net profits are up 61%. Interestingly, BSE is one of the few companies where both FIs and DIs are increasing stake and public holding has reduced. And this is not the first time BSE has outperformed. Over the last 2-3 years, BSE has successfully transitioned itself from being primarily a cash market exchange into a serious derivative player. Earlier, NSE completely dominated the F&O ecosystem, while BSE had very limited relevance in derivative. But things changed after management aggressively pushed Sensex and BankX's weekly expiry product. Then another important point is operating leverage. Exchange businesses are structurally very scalable. Whether 10 lakh trades happen or 1 crore trade happen, infrastructure costs do not rise proportionately. So incremental revenues largely flow directly into profit. That is why PAT growth becomes much more sharper once volumes scale up. And that is the reason I like platform companies. I've done a detailed video on platform business in India. As far as share price is concerned, its stock was consolidating for last 1 year, but recently there's a good uptick in share price. And after the result, stock has further moved positively. On valuation front, BSE has always commanded a premium valuation due to superior growth. But considering the growth company is delivering, in last few years, its historical PEG ratio is just around 1. Of course, 67% growth is not sustainable for long, but even if BSE can sustain growth at 30%, forward PEG ratio would be around 2, which is not very high. But the caveat is, provided the earning growth is 25-30%. The only risk we need to track is SEBI regulation around F&O trading. Over the last 1-2 years, regulators have repeatedly expressed concern about excessive retail speculation in derivative. If SEBI tightens rule, then derivative volume across exchange can slow materially. Fifth company that has posted simply crazy number is Ideaforge. Company's revenue have jumped 594% from 20 crore to 141 crore and PAT has jumped from losses to 60 crore gain. Now I remember discussing Ideaforge during its IPO days. How a young group from IIT Bombay started Ideaforge as a side project that eventually got listed on the market. There was a massive craze for its IPO as Ideaforge was India's first listed drone company. In fact, it had a bumper listing with 94% gain. However, since then, the business kept on underperforming for a long time and hence its stock price simply tanked badly. Interestingly, Ideaforge declared its result on 1st May and when market opened on 4th May, its stock price had already doubled from the lows. It seems the market was already expecting strong Q4 numbers and investors already started buying beforehand. Anyways, the most interesting part is the Q4 investor presentation and con call. The biggest takeaway for me was Ideaforge is pivoting beyond intelligence, surveillance and reconnaissance into combat drone capability. Now this is a great news. Drones have already become one of the most critical aspects of national security and Ideaforge entering into this space opens a whole new world of opportunities. Management said that we are actively developing combat drones for long-range attack, loitering munitions, kamikaze, etc. We have all the necessary building blocks available to use and are prepared to participate in the upcoming wave of opportunities. Earlier, investors were worried because order execution was weak, profitability had collapsed, and the defense procurement cycle was slowing. But now, company has delivered highest ever annual order inflow of 530 crore. Another very important point is order execution. Management highlighted that they executed nearly 40% of open order in Q4 itself despite geopolitical supply chain disruption. Company has entered FY27 with an opening order book of around 310 crore. That provides a meaningful revenue visibility. Management expects to execute this entire opening order book within the first 3 quarters of FY27. So FY26 revenue was 226 crore and company is guiding to achieve 310 crore of order within 3 quarters. That clearly shows FY27 should be very strong. Interestingly, company has achieved its first order in the United States and has become the first Indian UAV player to train NATO forces at the US National Test Pilot School. Clearly, Q4 was transformative for Ideaforge. But the key is, how sustainable is this? Because in the past, we have seen extreme volatility in business. So based on management commentary, FY27 is clearly looking promising. But of course, we cannot ignore the risk in the business. On one side, defense has a very strong tailwind. On another side, the risk is unpredictability of orders, as majority of them comes from government. In any case, definitely this company is worth tracking. If they can fetch few more orders, I think there can be more upside in the stock price. Now, apart from these 5 companies, there are various other names that have posted turnaround performance. For instance, Sterlite Technology and HFCL numbers were absolutely crazy. Both companies are beneficiary of strong optical cable fiber demand in data center. Although both companies have already rallied a lot. I recently discussed the business model, future prospect, and most important, key risk in both companies. There is a massive risk because both the companies have been a commoditized player. So watch that video. Apart from that, SG FinServ has posted exceptional number. I've already discussed the business model of SG FinServ in one of my videos. So overall, the bigger message from this Q4 result season so far is very simple. Markets eventually reward earning growth, execution, and future visibility. Not stories, not narratives, not cheap looking stock. And that's exactly why many of these stocks continue to trade near lifetime high despite already rallying sharply. Because when a company consistently delivers strong revenue growth, margin expansion, healthy guidance, improving balance sheet, and strong sectoral tailwind, the market keeps re-rating the business over time. But at the same time, investing is not about blindly chasing momentum either. A stock can become expensive if expectations become unrealistic. So the key is not just finding companies with strong Q4 number, but identifying business where the future growth runway is still long, management execution remains strong, industry tailwind are structural, and valuation still leaves some room for compounding ahead. Because ultimately, over the long term, stock price follows earning. But of course, market will never move in a straight line. Even the best businesses go through correction, volatility, and temporary slowdown. So position sizing, patience, and valuation discipline remain equally important. Strong businesses can create wealth over a long period, but only if you avoid emotional decision making during temporary market fluctuations. Anyways, these were 5 companies where Q4 performance genuinely stood out and where the market is clearly rewarding execution. Let me know in the comment which company in Q4 results surprised you the most in this season. Also, since we are still in Q4 result season, there will be more names that can surprise us. So if you want part 2 of this video, let me know in the comments. And if you like such deep dive fundamental analysis where we discuss not just the number, but also business model, management commentary, future earning drivers, and key risks, then do consider subscribing. Finally, there are many companies that have underperformed, including the entire IT sector. Obviously, it's not possible for me to discuss everything here, but I ensure that I cover majority of this in my weekly video series. For more details, you can explore the link in the pinned comment. I'll see you next video. Till then, take care.